Building a modern financial institution typically means bolting new software onto decades-old legacy code. Jio Financial Services is bypassing legacy banking infrastructure entirely. They operate with two distinct advantages. First, massive capital backing. Second, a completely clean slate, an operational structure entirely free of tech debt. We can see exactly what they are building on that clean slate by looking at their Q1 FY27 financial results. In a single quarter, they launched cross-border payment operations, expanded their AMC offerings, and initiated aggressive lending protocols. Yet the market's response to this rollout has been severely muted. Instead of rallying on this execution, the asset's price has been trapped in a rigid, protracted consolidation pattern. The price action is completely ignoring the fundamental scaling. To understand this valuation compression, we have to map the company's internal structural velocity directly against its external technical market setup. The tension between this fundamental velocity and the market's current inertia creates a structural gap that we need to reconcile. We deconstruct Jio's architecture starting at the foundation with their proprietary product suite. This funnels users into a marketplace tier, pulling data from fixed deposits, mutual funds, and credit cards. These feed the core pivot at the top: borrow, invest, transact, and protect. Let's run the numbers on that Q1 execution, starting with the protect pillar. In their first quarter of operations, the insurance sector generated 266 crore rupees in gross written premium. They leveraged their massive capital base to secure lead reinsurer status on major treaty programs right out of the gate, commanding priority market access. The volume is equally aggressive over in the borrow pillar. Their non-banking financial company drove quarterly disbursements past the 11,000 crore rupee mark. The engine is running at high volume. Jio has constructed a fully capitalized, high-volume ecosystem architecture in record time. The architecture scale is only half the equation. The other half is data efficiency. This is where their AI-native margin engine takes over. The ecosystem runs on two AI frameworks: an agentic workflow system and a neural network with 16 AI agents and 10 machine learning models. This automatically resolves 53% of fraudulent emails and auto-reports 61% of suspicious activity without human intervention. Risk analysis and policy reviews are executing 50% faster, cutting associated compliance costs in half. Customer acquisition costs have plummeted, reporting 90% savings by generating marketing assets with AI. This marketing is highly targeted. A recommendation engine analyzes over 800 behavioral events to hyper-personalize the interface, driving a massive 56% conversion rate. In legacy banking, scaling a loan book past 11,000 crore rupees requires a linear increase in human operational costs. Jio Finance has successfully decoupled ecosystem scale from operational bloat, creating a unit economics profile optimized for high-velocity margin expansion. The internal fundamentals are expanding rapidly, but the external market sentiment tells a completely different story. On this daily chart of Jio Financial Services, we see an initial steep downward price correction. Finding a floor below 300, it failed to initiate a new uptrend. Instead, it formed a series of lower highs, capped by this descending yellow channel. That descending resistance line represents institutional selling pressure. Every time the stock tries to rally on fundamental news, sellers step in and halt the momentum, but there is a counterforce. Buyers are stepping in at progressively higher levels, forming a rising support floor underneath the price action, right around the 220 to 230 range. Put these two boundaries together, and you get a symmetrical triangle consolidation. The price is literally trapped between two opposing forces, coiling tighter and tighter. To understand what the market is thinking right now, look at the volume profile down at the bottom. As the price action compresses, the volume bars have gone flat and are steadily declining. Declining volume during structural compression is a classic hallmark of market indecision. Institutional capital is sitting on the sidelines, waiting for a definitive catalyst. The technical chart shows a market in high-tension equilibrium, outright refusing to price in the fundamental AI-driven scale until a structural breakout actually occurs. We are looking at two opposing realities: an internal ecosystem expanding aggressively and an external stock chart compressing into a tight point. Jio Finance is a coiled spring. The AI-native unit economics and the billions in disbursements represent kinetic energy waiting for a technical release. Because the apex of this symmetrical triangle is rapidly approaching, this period of valuation indecision has a strict mathematical time limit. The price must break one way or the other. A resolution to this pattern requires a high-volume break above that yellow descending resistance line. Sustained fundamental execution, specifically maintaining those 11,000 crore disbursement levels and rising marketplace conversions, is the most likely catalyst to pull that sideline volume back into the market. The market's current technical structure is restraining the price, but the sheer gravity of Jio's zero tech dot execution makes this one of the most compelling fundamental divergence plays available today.